All right, we got another great webinar. We've got Adam Collins from Movement Capital, who's going to be joining us regularly to talk about the Commitment of Traders report. He has a whole number of websites actually created to show all different charts and different ways of expressing seasonality and the commitment of traders, positioning, and different ways of looking at all that data. It's really interesting, and so he's going to be joining us regularly. And today he's going to talk to us about what he sees out there. So I'll let Adam take it from here.
All right, cool. Well, happy to be presenting. Right off the bat, we've got all disclosures. None of this is investment advice. And so initially, who am I? So my name's Adam Collins. How I got into finance is went to college, was a finance major, but was really bored with the, curriculum. And so I read every book I could. Two that really stood out that I thought were really useful. One was an older one called The Futures Game, and it's sort of this like academic look at who succeeds, who loses in trading. And it's honestly sort of depressing when you read it, but it's a good foundation to craft like realistic expectations. So that was a good one. And then Caleb's first book, Fooled by Randomness, before he wrote Black Swan, also really, really enjoyed. And it just shows like, luck has a big impact in trading. So, I was doing that in college. And it was after my sophomore year. And I was on that path and I was like, wait a second, I don't actually know if this is what, I want to do with my life. And so I didn't want to wake up after graduating and be like, oh, I got a degree in the wrong thing. And so I took a year off and I worked for a CTA and I only had one job. And it was a good job. It wasn't like a, intern role, like getting coffee. He looked at me, he was like, I need to make sense of the CoT report and I need to, implement that into a trading framework. And so I did that for the whole year, was work with CoT data. So worked at the fund, went back to school, graduated, and then the day after I graduated, I started my investment firm. It's called Movement Capital, and I do two things. I do investment management for local individual investors, and then research, which is everything that's on the internet that people see. So what did my trading path look like? And so I started out writing options, which I think a lot of novices do because they get attracted to like the payoff profile and like the percent of winners. And just quickly learned that one, I wasn't sort of compatible with that in that, everybody knows when you're an option writer, you win, small. And then when you lose, it's, an order of magnitude larger. And mentally, I wasn't compatible with that. And then options, there's obviously plenty of like talented options traders, but I feel that when you're a newcomer and you get exposed to options, you fall down this rabbit hole of these complex structures, and it gives you this false illusion of, this false illusion of precision of like, oh, if I can do, this certain structure, I can eliminate, risks 1, 2, and 3. It's really not that. And so I didn't really like that. And so moved to intraday scalping and treasuries. And the guy who sort of mentored me was a guy named John Grady. He's a very talented treasury trader, and he was doing, short-term order flow stuff in basically the 10-year and the 30-year. And main lessons from that is that, when you're trading, it's sort of like a second, order thing of, it's not just what you think, it's what you think other people think and how they'll act on that. And his main thing was, identifying levels in the market where people are underpaying and will be forced to make a trade. And then another takeaway from that was that, because it was sort of like a multi-month mentorship. And when I was watching him, 95% of the time, it was extremely boring. And so more often than not, the correct thing to do is nothing. And so nowadays, my sort of framework is a lot longer term, and it's not discretionary, it's more systematic. And the reason, and I don't view that as being like the correct path, it's just what really synced up with me. And that sort of framework and style is a function of the CTA that I work for, where I got really exposed to that. And it just, it clicked more than, more than order flow stuff, option stuff. So that's more so what I do now. So let me give you like an example setup of stuff that I'm looking for. So let's say you've got a commodity and it's in an uptrend. Let's say it's, term structures and backwardation, which is, a tailwind for people with long exposure. Let's say positioning is the opposite. of where everybody's on the other side of the boat, and then let's say you've got a slight seasonal edge. So that's an example of things I like to look at. So when you think about risk and things that I think are a core principle, I'm not the type of person to have one or two trade zone. I think it's too concentrated. It's too emotionally charged, and so at any given point, I've probably got 10 to 20 position zone. But with that, you can't sort of fool yourself into thinking, I'm long copper, I'm long S&P, and so that's typically correlated. And so, long story short, what I'm saying is that I don't ever bank on correlations persisting, because I think a lot of people do that and delude themselves into taking more risk. And they sort of look at their book and say, oh, well, this is going to protect me when X, Y, Z happens. And I've just found that more often than not, the market isn't structured that way. And so, maintain 10 to 20 positions, but bank on correlations, go into one. Don't use a lot of leverage. I've read too many books about long-term capital management and what happened there. A great one is called Crisis of Crowding. And take away from a lot of these huge blow-ups. It's the smartest people in the world, much smarter people than me. And in the remnants of all these blow-ups was just too much leverage. And so tend not to use it. One thing that I learned from Mark Fisher's Logical Trader was that time stops are as important as price stops. And so average trader, okay, so what gets them out of a trade is they're typically knocked out by price trading against them to a certain level. But when you think about trading, it's like a business like any other. And so if you're a grocery store and you stock a new type of milk and it doesn't sell, if you're a smart grocery store operator, you're probably not going to restock that milk. And so the analogy with trading is if you put a position on, and let's say its original thesis is measured in, I don't know, a couple days, and let's say 2-3 trading days go by and price is right where you put the trade on, it's not working for you. And so remove it. Don't let it prove you wrong. You pull it out. And so another thing I do is I don't use crazy structures. I don't spread hardly at all. I just use outrights. And so keep it simple. Like I said, I don't think that's like the best thing at all. It just fits with me. And then one thing that I've actually found is pretty, common between a lot of people I talk to is you're always looking for an asymmetric risk reward. And so if you can have a low probability of being right, but a high risk reward, typically works out in favor. I'm a lot less shorter term than I used to be. And it's because, I don't know, when you look at hard numbers for commissions, slippage, and when you look at that and you compound it over time, it really eats away at you. And so you really have to have like a massive account to justify, doing a large amounts of round trips, during a day. And so to me in trading, like for the analogy of like trading a business, when you're trading, your overhead is your cost of doing business. And that's typically synonymous with, the software you're paying for, and then also transaction costs. And so I try to keep that as low as possible. Then I think the most important thing out of everything I just said, you could ignore all of it. If you take somebody who approaches the markets and they're depressed and they're unhealthy, and let's say they're chronically getting 3-4 hours of sleep, you're not going to succeed in anything, let alone trading. And so you have to fix that. You got to get mentally right. I don't know. You need to eat relatively clean, I think, and then try to get some sleep. And when you take that framework, you're going to have a higher probability of success, be it trading, be it relationships, be it any other professional endeavor. And so, signals. So other stuff I like to look at on a different note. For a lot of risk assets, be it equities or like industrial commodities, I love to try to get a handle on like probability of recession. Like with equities, people write about, valuations are X, profit margins are X. And all of that stuff is tertiary in my mind. Like bull markets don't stop in stocks because people suddenly wake up and they're like, you know what? We're going to target a 17 times multiple in the S&P. It doesn't happen. All these markets are more driven by long-term business cycle stuff. And stocks have the biggest drawdowns when a recession materializes. And so when it comes to thinking of recessions, you want to look at macroeconomic indicators like retail sales, industrial production, unemployment rate. And you might ask, okay, how do you look at it? So try not to overfit it. Just look at like year over year change. So the US economy, 70% of the GDP is consumption driven. If retail sales are contracting year over year, in plain English, it means that people are spending less money. It's typically not good for the economy. And so you can throw in other stuff, ISM, PMI, payrolls, whatever. And so I want to get a handle on probability of recession. I want to look at, momentum, the degree of trend in every market I track. So short-term trend, long-term trend. And then something I think people ignore with trend is not just, okay, what's the 12-month, moving average or whatever, but what's the smoothness of it? So for example, in single stocks, let's take two stocks. One of them's a biotech that, gaps up 100%, does nothing for the rest of the year. Another one is some stock that gains, in an ideal world, 25 bips a day, every day. And so I'm going to prefer the latter. And that applies not to just stocks, but other assets. So another thing I always pay attention to is term structure. So the degree of contango or backwardation. Obviously, it's really important in VIX futures, but it's equally as important in commodities. Also, what I'll talk about more is CoT positioning. And more importantly, and I'll get into it, you can't just look at CoT. Somebody tells you, oh, specs are short gold. Doesn't matter. I don't care about that. You have to put it in the context of, are the people that are in that trade, are they feeling pain? Or are they sitting pretty? The trade's going with them. They've got no big catalyst to pull out. And so that's how I think about it. And then I like to look at the spread between implied and realized volatility. It sort of gives you sort of I call it like the heartbeat or the pace of the market. So if you see, if you see that spread sort of, if it's really big and it's decreasing, people are chronically overpaying for implied vol, and that says something to me. And then last thing that's sort of like non-quantitative is, are people talking about it? So for example, do not have a position in Tesla, because every time I load up Twitter, everybody's passionately, either long or short or whatever. And I've just personally found that, like, I do best in things that are not where all the eyeballs are. And yeah, so I try to do, I don't know, stuff that less people at least are looking at. All right, so let's talk about the one thing I might, know something about is positioning. So the CoT report is a thing that comes out each week by the regulator of commodity markets called the CFTC. And it just breaks down how people are positioned. And there's two main categories. You got speculators, people who trade for a profit, and then commercials, like producers and users, who their main objective is not a profit. Their main objective is to hedge price risk. So if you're a producer, you're selling futures to lock in prices for your future production. And if you're a user, you're buying futures to lock in the price for your future inventory needs. And so the issue is that, the CoT report gets published, and everybody, Friday afternoon pushes their stuff, and they say, oh, people in crude, they reduce, specs reduce their net long exposure by 10,000 contracts. Doesn't mean anything. You need to know context. You need to know whether current positioning is extreme or not relative to the past. And my solution, it's not unique, other people do it, is it's just a 5-year percentile. And so you're taking so think about this. Let's say you got a commodity like wheat, and let's say you're looking at speculators. So let's say the spec net position is 100,000 contracts. And let's say the spec net position is 100,000 contracts. Let's say the open interest is 400,000 contracts. So that means the net spec position as a percent of OI is 25%. You hear that, you're like, okay, you actually shouldn't deduce anything from that, because what you need to do is normalize it to, has that number been high or low relative to the past? And so you just create a 5-year percentile. And so a percentile ranges from 100 to 0%. If it's 100, it means that trader's net position is greater than it's ever been over the past 5 years. If it's 0, it means it's lower than it's ever been. And so it's a quick way to know across multiple markets if people are really bullish, really bearish something. The biggest issue people have with CoT is they always stop the analysis at whether people are long or short. And so that's what get headlines and traction, is when people tweet out something of saying, oh my God, look, everybody's long this, everybody's short this. But think about this, because this was a big thing last year in crude. Everybody was pointing out how crude was a super crowded spec long trade. But think about this. So the rally and fall of last year, it was relatively steady from in the front month from $45 to $60 per barrel. And if you were a fund manager that was long crude, it wasn't this crazy volatile trade that was like trying to shake you out, right? And so if you were long crude, you never had this big incentive to bail out. And so to me, you have to pair together extreme positioning with, is price action hurting them? And more often than not, it isn't. And when COT becomes most actionable is when it is. Because think about this. If everybody's on one side of the boat and things are, going smooth and trends going their way, COT is not really relevant to me. But if you've got really crowded positioning and you've got price action that's starting to disagree with them, like let's say everybody's long and it gaps down 7% in a week. Okay, then we got something. That's the equivalent of yelling, fire in the theater. There's a big incentive for everybody to pursue the exit at the same time. Okay, and another issue with COT that I run into a lot, everybody still uses the legacy report. So there's two versions. There's the old legacy report, which started in 1986, and then there's the new disaggregated report, which starts in 2006. And so the difference is this. The old legacy report was really opaque. I think there were like 3 total categories. It was like commercial, non-commercial, and then non-reportable, which sort of represented like small speculators. The newer disaggregated report, it just breaks stuff down into more sort of transparent buckets of, you've got leverage money, typically hedge funds, CTAs. You've got asset managers, typically slower money. You've got commercials, and you've got swap dealers. It's very important that they broke those out because they can trade for a number of different reasons. And I'll get more into it, but legacy report to me, I do not spend a second on it. It's so ambiguous that it doesn't have any use for me. And I solely use the disaggregated report. All right, so why do I focus on spec positioning? Because 30 years ago, speculators were not a big deal in commodity markets. What this chart shows is over time, all listed commodity futures look at the percentage of open interest that is controlled by speculators. 30 years ago, they were the small fish in a big pond. Hedgers were dominant. Now, the roles haven't reversed, but speculators, they control a lot more of the OI. So that's why, they play a bigger role in the markets, and hence like to pay attention to how they're positioned. All right, so this is an example of like the actual charts I use. And the 2 lines at the bottom are those 5-year percentile numbers for the 2 big trader categories. You got the commercials, producers and users, and the speculators. So 100%, like right now, for example, in platinum, the 5-year percentile is like almost at 0%. And so what you can infer from that is that people are really, really short platinum. But remember, you got to pair that with, is price agreeing with them or disagreeing with them? And right now, it's agreeing with them. Platinum's been a steady downtrend. So this isn't a thing you go out and fade. But this is sort of the distillation of how I look at positioning the percentile. Same chart in gold, sort of similar story, not as extreme, but yeah, gold's definitely gotten less popular. One difference between these two is that commercials are a lot more bullish in platinum than in gold. And what you can infer from that, so when I say something like commercials are bullish, it means that there aren't a ton of producers selling to hedge their future production. They're saying, price is low, we don't want to hedge future production here. But you probably have more users looking at the low price being like, I would love to lock in, future inventory costs this level. And that's happening more so in platinum right now than gold. So I don't just look at the 5-year percentile. I like to look at like dollar amount too. If you like to stick in the net position and multiply it by the front month contract price for that week. And so here's gold. So on the left-hand side, we got commercials. On the right-hand side, we got speculators. And so you can see how on the left, commercials are net short, like, I think it's like 7 or 6 billion, and you might look at that graph and be like, whoa, this is interesting. They're never really net long. It's because in commodity markets, producers dominate users. So think about this. If you're a producer, typically you're more levered to the commodity. And so if you're a corn farmer and you know that your farm is going to go bust if you get less than XYZ for corn, you've got a really big incentive to hedge if the price is satisfactory. But a number of commodity users have more flexibility in passing price increases on to consumers. And so that's why you tend to see lots more producer selling than user buying. Anyways, on the chart to the right, you can see that speculators are, they're getting less bullish on gold. We're not at the 2015 lows in positioning, but we're getting close to it. We've seen a really big reduction in gold positioning. Here's a great example of combining positioning and price action. So early this year, lumber massive trend in commodity markets. And spec positioning stayed very long for the duration of that trend. And people were trying to fade it. It's like, oh my God, this thing's gone up 80% in a couple months. Everybody's long. I'm gonna be the contrarian. I'm gonna nail it. I'm gonna sell lumber. And that's not what you should do. And so to me, lumber became actionable when it really started unwinding in a nasty way a couple weeks ago. And you had this beautiful setup of people were still fairly net long, but price was hurting them. And so that's a good example of that. Another one more timely is copper. This was really nasty in copper, of where like a month or two ago, specs got, now this is CME, this isn't LME positioning, but specs got super net long copper. They were net long more than 5 billion, which is getting close to an all-time high in net spec positioning. Right after they got super net long, copper just got murdered. And so it just flew in their face. And so this is a good example of at least why to keep positioning on your radar, because when it reverses hard, it reverses really hard, especially when positioning is so extreme. Okay, so that was commodities. Let's turn to currency. So these are two currencies that stand out to me with really crowded position right now. And I will preface this with a caveat. CoT data is most relevant for commodities because commodity futures are the primary market for commodities. CoT data on listed currency futures, that does not cover spot FX positioning, and likewise with equity futures, CoT positioning doesn't cover cash equity positioning. And so that being said, I still think it's fairly representative, so I still pay attention to it. So on the left we've got the New Zealand dollar, on the right we've got the Swiss franc. Same story in both, just different ways to look at the data. So both trades are very crowded shorts. People are betting on the New Zealand dollar and the Swiss franc to fall in value relative to the USD. And it's to a surprising magnitude, because like both currencies have fallen in value, and they've been in a somewhat downturn, but it's not like they've been in a massive downturn. And so the degree of bearishness and negative positioning is I don't know, sort of surprising to me. This is probably my most popular chart. It's looking at sort of a composite of things. It's looking at the net spec positioning of the disaggregated report in ES, the S&P 500 E-mini, in the NASDAQ, and in the Dow, the mini versions of all the contracts, adding up sort of that net exposure and then multiplying it by the multiplier values and the values of the indices. And the output is a very concise number. It's in pure dollars. How are specs positioned in equity futures? And we hit in late January all-time high. It was like 140 billion. This massive thing was nuts. We've come back a lot relative to. Look at this. So this is sort of interesting to me, of where S&P we're almost 1% off from all-time highs, and positioning has gone the other way. And so specs have gone from net long 140 billion to net long 60. We're still on an absolute level fairly net long if you're talking about 60 billion in net long exposure, but it's a really quick reduction. You're cutting 80 billion in net long exposure, which is a very rapid reduction. And so it's not as if this is early 2016 where people were net short. But yeah, it's whenever you see sort of a divergence between speculators, sort of getting bearish and price going against them, that's always an interesting setup to me. But go to the next chart. These are the charts that I pay the most attention to. So this is just an aggregate of the data and stuff like this. You see how you get the current. Right? These charts
put it all in one place. What this is looking at commodity futures, how speculators are positioned in each sort of bar is the current 5-year
percentile, with 100% being, wow, speculators are super long that, 0% being, wow, they're super short that. So here's a current snapshot as of the most recent CoT report, where people long and short. Wheat has gone from a fairly consistent short position to specs are in long wheat right now, and so that's sort of a semi-crowded long. Crude's been there for a while on the left-hand side, and then some smaller stuff like rice and OJ. On the right-hand side, you've got platinum, like I talked about, and then coffee too. Also gold. Gold's definitely made its way down. And also I want to note, I define extreme positioning as a 5-year percentile greater than 90% or less than 10%. And so the stuff in the middle, I don't really care about. This is the same data for financial futures. So this was commodities, This is financials. So on the
Left, we've got Mexican peso, on the right,
we've got New Zealand dollars, that's right. And then some other consensus loans are like Nikkei and the Euro, which you've probably read about. And then we've got hedger positioning summary. And so this is sort of the inverse of the commodity spec positioning, but so you're sort of looking at, okay, how do hedgers stand in commodity futures right now? So on the left-hand side, when you see stuff like 100% coffee, 95% platinum, what that's saying is there's not a lot of producer selling and there's more user buying. And so it's commercials in aggregate not wanting to, it's sort of commercials being less net short. And that definitely exists for extreme sort of like, I guess, bullish position on the left, but there's no real extreme commercial short positioning. So moving on to seasonality. So positioning is the main stuff we talk about, but it also covers some seasonality.
these are my main parts. My seasonality logic is very simple. You're looking at the front month price and you're roll adjusting it. So the majority of stuff in the front month, and obviously
You need to factor in roll cost, and so all this data is roll adjusted as if you had a front month position that rolled forward. And so we got goals on the left, and then the monthly averages on the right, and the lines sort of are different seasonal averages for different years. And so gold sort of started the year off sticking to historical seasonality. Most metals pop in January, February, and then it sort of did nothing in this Q1, and then it's just sort of fallen apart. And it typically, gold and a lot of these risk-off assets like gold, yen, 30-year, they typically catch a bid in August. And so you can see that in the monthly data on the right. So maybe that's something to watch out for. Then we've got similar seasonality data for the 30-year bond. Like I talked about, risk-off typically catches a bid in August. Another thing I like to pay attention to on the right is rolling 12-month momentum. And so to me, that's a proxy for trend. And when that number's negative, you tend to have like longer term CTAs buy short. And if momentum is positive, you tend to have trend followers jump on the long side. And so anybody knows, momentum's negative in bonds. Most trend followers are probably biased to the short side in bonds. So this is my most important seasonality graph. This is looking at the 20-year average monthly performance for commodity futures in the month of August. So what are the winners? What are the losers? Best performing contract over the past 20 years has been the 30-year bond in August. And then heating oils right behind it. Then you got RBOB. And then on the right-hand side, the worst performing assets in August are S&P, makes sense, sort of opposite of 30-year bond seasonality. And then palladium and natural gas. So those two are sort of interesting. Then I'm wrapping up with some of my, it's not my stuff, but it's my favorite charts I've run across this year. So as we all know, I wouldn't be somebody to call the end of the bond bull market. You can't just draw a horizontal line and be like, we're over, but you can sort of, put context to it. And the degree of the bull market has been absurd. I love the chart on the right. It shows sort of the magnitude of what we've seen since 1981 relative to, bonds going back to the 1920s. And this is the reason why this is bad is because it's like a Pavlovian response of not necessarily traders, but longer term investors. They've constantly been rewarded for taking duration risk. And I think over the span of multiple generations, that creates, bad habits. And a lot of people say, hey, I don't really care about this chart right here because we're
bond exposure. I don't have a ton of duration risk. Biggest bond index is the Barclays aggregate, and its duration has almost doubled since the
2009 lows. And so if you've got big bond benchmarks in your portfolio, you have a lot more duration risk than you used to have. Love this chart. So this is from GMO, and people have pointed out how, ever since 2000, stocks and bonds have been this beautiful negatively correlated pair. That's why risk parity has worked so well. Great things can happen if you lever up stocks and bonds and they are negatively correlated. But that's not the historical relationship. More often than not, they've been positively correlated. And that's not a novel insight. People have talked about that. But what's interesting is the chart on the right, where it shows that, okay, so look on the right-hand side of the chart on the right. It says, let's take sort of a risk parity portfolio that's, 60 stocks, 80 bonds, negative cash because you're borrowing. And when you've got a negative correlation between the stocks and bonds, that's a less volatile portfolio. And then if you flip to a positive correlation in those assets, it results in a more volatile portfolio. And so the implication is this: if we revert to a more normal, correlation relationship between stocks and bonds, you're probably going to see more volatility. And then sort of different topic, inflation. Probably everybody in this community is keyed into the fact that, inflation's been a growing narrative. Companies are reporting cost pressures on their earnings calls. But what's pretty interesting is that consumers aren't sharing that sentiment. And so this is a thing called the Inflation Uncertainty Index. And consumers, when polled, are saying, hey, we're not really worried about it. And so that's sort of a divergence between the two. Love this. So this is showing the return of 10-year bonds during really bad S&P months, as defined by the S&P falling more than 5%. A lot of people think that when you sort of decompose the bond return in months when the S&P really falls, it's because, bonds rip, they rise in price a lot. That's not the case. When you look back, the majority of bond return when stocks have done very poorly is from the coupon and not the capital appreciation. The takeaway is this: if you're leaning on bonds to bail out an equity-heavy portfolio when the S&P falls, with yields so low, there's only so much they can do because you're not going to get as much of a coupon buffer. And so that was sort of interesting. This is just showing different commodity correlations to the USD. And so people treat commodities as like this homogenous asset class, and it's not. So the stuff that's really negatively correlated, energies. The stuff that really doesn't care, stuff like livestock and some of the soft commodities. This shows that this is why I pay attention to term structure and the sort of the degree of contango backwardation. PIMCO put out a study and they said, hey, let's look at two things. Let's look at spot price changes and then the starting sort of roll yield of a commodity futures position. And I think they're looking at like front month between M1 and M2. They're saying what's more correlated to future returns, changes in the underlying spot price or the initial degree of contango backwardation. They found a higher amount of correlation between future returns and starting roll yield. And the takeaway from that to me is this: when you go into a trade, especially if it's a longer term trade, you need to know what the shape of that curve is. And so like a lot of people have tried to go long sugar recently, and it's been in this like really huge contango. And the issue is if you're maintaining front month exposure to sugar and it's got 3% monthly contango, like have fun rolling that position. It's just going to bleed you dry. And so that's why I pay attention to that. This is something I pulled this morning actually. Of, as we all know, buybacks are big in 2018, and since Q2 earnings, the bulk of it sort of is behind us. We're sort of past the blackout season, and so over the next couple of weeks, a lot of companies are going to be going full throttle with buybacks, and this year even to the nth degree. And so if you're trading equities, be very cognizant of the fact that the next couple of weeks have historically seen larger than usual, degree of buybacks. I love this is the tail risk chart that it's like the global fund manager survey thing. And this shows over time what has been the most common quoted tail risk. And I've got a general rule of thumb, which is if I load up Twitter and everybody's freaking out about something, I'm not going to add any value by also freaking out about that thing. And so if you look back at this has been a permanent fate. When people are scared about, sovereign debt risk in the EU, that was the bottom in Europe. People concerned about China hard landing, that was right before the massive Chinese reflation. And so right now, biggest risk is trade war. And so not to sort of like diminish that at all, but if you say something like, wow, I think, trade war is the biggest black swan, it's not a black swan if everybody's looking at it. And then also, everybody's talking about the yield curve, and as if it's this crystal ball, as if we're all going to wake up and the yield curve's going to flatten, and then we're going to pull S&P exposure and just nail the recession. It's not how it works. This is from an awesome company called Variant Perception. And they showed that since 1991, Japan has had a number of recessions, and their curve hasn't inverted prior to any of them. And remember, they got low with rates way before we did, and so I don't know. I just don't think yield curve is going to be as simple going forward. So that was pretty much it. I hope it was enjoyable. And my main takeaway, because I'm talking about the most, is CoT data. this is what you're trying to find. You're trying to find the pain trade. You're trying to identify, what contracts everybody is, crowded long or short. That's the first level. The second level that's more important is, when and if they're starting to fall under pressure. And so, anyways, if you've got any questions, feel free to ask. I'm happy to answer.
That was great, Adam. A lot of, you talked about basically every single market, really gave a good overview of how you look at things. There are a few questions. I actually had one. We brought up a really interesting chart about equities, the positioning versus, I guess you're scrolling back a few. Yes.
That.
Yeah. So how can you, what's your thoughts on how to explain that, basically, the equity positioning versus the trend in the market, multi-year trend straight up?
Are you talking about like the recent development, or are you talking about the fact that we've drifted higher in positioning over time?
Yeah, the fact that we've, the fact that we've drifted higher in positioning, basically.
Oh, it's just, you're always gonna have an upward drift in these nominal positioning numbers. Sort of like, here's an analogy. People talk about like margin debt, and they quote these massively scary numbers like, oh my God, margin debt's never been $650 billion before. Surprise, surprise, when you have an economy that's driven by credit, you're gonna have these ever increasing larger, dollar amounts of positioning, be it margin debt or this. And so that wouldn't be the main. So what I'm getting at is, with this chart, I would expect a gradual march higher in net long spec positioning, not just in ES, but also in crude. I don't have the chart, but it's basically this. Think about this. Some of these commodity markets, like for example, pre-05, there's a paper that came out in 05 that basically said commodities for the long run. And it was saying, commodities have delivered, S&P like returns with no correlation to S&P, everybody getting the commodities. You saw this huge institutional inflow into commodities. And so that a ton of money came in. And ever since, you've seen this gradual drift higher in spec positioning in WTI. And so to answer your question, drift higher, slow drift higher equals expected. But the more interesting thing to me is recently, so like more often than not, spec positioning tracks price. Things go up, people get long. But the past couple of weeks in the ES, you've seen, like I said, this massive cut in net long positioning, but now we're almost back at the highs. And so the behavioral takeaway is this: if we break all-time highs, you're gonna see people, at least in my opinion, want to not miss out, and they're gonna pull back in, and they've got ammo because they've reduced their net long exposure by 80 billion. That's 80 billion that can come back, in my opinion. And so I don't know, that's how I think about that.
And then you mentioned the seasonality chart. So looking at your seasonality chart for August, looking at it, it looked like, so bonds higher, meaning that yields lower, right?
Correct. Yeah.
Typically for August, and then natural gas, and is that palladium that are typically the underperformers?
Yeah, and so ZB, 30-year, I think that's right. Here's sort of like, you could see, look at this white line for the month of August where it like markedly increases. That's saying that going back 20 years, if you're taking the August monthly change in the 30-year, and you roll adjustment, it's typically been 2-3%, and that's not unique to 30-year. It's because everybody knows this, but August has been one of the more volatile months for like risk assets, and so August, positive seasonality is going to be 30-year, yen, gold, and probably negative S&P.
Okay. Somebody's asking, Mike is asking, hey Adam, you mentioned earlier you look at percent chance of economic recession as a very key number.
Yep.
What percentages are we at now, and how do you even gauge that?
Okay, so a couple answers. How I gauge it? Look at a bunch of stuff. So the indicators that are important, some people try to get cute with like, predicting recession. They've got, these leading economic indicators, very fast signals. And I know that, like, I just don't think I will have that crystal ball of being able to say in 6 months we will be in a recession. I'm trying to look right now. What is our probability right now? How I do that is look at, sort of coincident economic indicators. like here, the three I mentioned: retail sales, which monitors consumer spending in the US, industrial production, which is business activity, the unemployment rate. And you might ask, how do you look at that? Simple. I'll look at it relative to a moving average. If the unemployment rate is trending lower as defined by below like a 10 or 12 month moving average, okay, so in plain English, that means that there are less unemployed people, that our labor market is tighter, that our consumers probably healthier, they're probably spending more money, which means the economy is probably strong. And so there's other stuff you can look at: housing starts. You can look at sort of different ways to look at, business activity, like the ISM PMI. And the way I look at it is this: I don't try to output a percent of, maybe I worded this wrong. It's not so much a percent probability of recession, but for each of these indicators, I sort of have a simple switch, sort of a binary yes, no. So for retail sales, if it's positive year over year, historically, that has almost never coincided with a recession. But when you're negative year over year, people spending less money, recessions have been a lot more frequent when it's been negative year over year. And so for each of these indicators, I've got the indicator, I've got a threshold. So for retail sales, industrial production, it's 0% year over year. So if they're expanding, probably not in a recession. If they're contracting, if businesses are expanding less, et cetera, probability of recession equals higher. And so that's what I think about that. And I put this all up for free on my website. It's called simplestockmodel.com/macro, and all those indicators are up there, and it shows what they're currently rated.
Interesting. So another question, this by the dip says, for a contract, if there's a buyer for every seller, how does CoT positioning even work?
So that's an interesting question when it's posed. But if I go out and I place a trade and I go long, gold or something, and I'm classified by the CFTC as a speculator. Okay, so that's like a +1 tally mark for long exposure. And if there's a hedger out there and they're selling, 500, corn futures, and they're classified as a hedger, that gets sort of aggregated into the short bucket. And so you're right in that it sort of all aggregates at the net level of an open interest of equal amounts of longs and shorts, but it's you can see how the market tilts. And so I'm glad I sort of had this pulled up, is so what this is showing the CoT report in the 10-year treasury. And the reason why I brought it up is not really to answer this question, but a big narrative lately has been everybody short bonds, they're gonna rip, right? Because they pull up this chart and it's of the old legacy CoT report, and to me, it doesn't really mean anything. So look, this is the disaggregated data. The disaggregated data for financial futures has 4 main sort of spec related categories. You got asset managers, you've got leverage money, you've got other reportables, and you got non-reportables. And so, and you've got, for each of those categories, a number of contracts, that category long and short. So to get a net, you simply add up the longs, you add up the shorts, and then you get a net spec position. And then remember what I do is, so this number, if you heard in isolation, specs are net long, 286,000 contracts of the 10-year, you wouldn't even know what that is, if that's extreme or not. Then you got to scale it by the open interest. So you take this, you divide it by this, but that's still, you don't know much there. You don't know if that number's high or low relative to the past. Then you take a 5-year percentile. And so it's looking back over the past 5 years and saying, hey, is this number high or low? And the truth of 10-year positioning is that speculators are actually quite net long. And you might say, whoa, how does this reconcile? It's because this is using the more granular disaggregated report. It's not using the old legacy report. But I will say this, with CoT report, I do make a point not to read into bond positioning, because bonds are obviously, they're frequently spread against each other. And so if you're looking at, positioning just the 10-year, you don't know what that is relative to people spreading it with the 30-year, et cetera. And so you'll notice in my tweets and stuff, I never really talk about bond positioning, just because I think I just think it's really tough to discern true positioning. But I will say this, that if you're isolating the 10-year contract by itself, it is not the crowded short that people have made it out to be, in my opinion, at least.
That's interesting comment there, and good reference. Okay, well, look, I think that you provided a lot of great information. Right now, no other questions. Thanks a lot for the webinar. Did you have any closing comments or any thoughts?
Oh, no, but as always, I'm extremely happy to answer any questions. And so there's my email if anybody's got questions. I appreciate it, and thanks for the opportunity.
Definitely. Thanks a lot, Adam.
Okay, bye.